And the market seemed to be kind of on the cusp of another rally if we get a tax, this tax bill through, but it doesn't really impact GDP and it won't really impact inflation either.
Well, we can take a short-term and a long-term view on this. Short-term, it looks from everything we know so far that it's going to add $7 a share to the S&P 500. So, there's no way to cut this other than to see that this is a windfall gain for stocks for next year. And then we can debate about the long-term implications. My intuition is this is going to cost more than it is going to yield in terms of extra taxes. But let's not forget that the typical American narrative about this is that God created Republicans to cut taxes. This is the single most important demonstration of being in charge of not only the White House, but Congress and Senate. If Donald Trump didn't get this through, it would weaken him much more than many other of the conflicts that we have been discussing right now. So he's got to get this through just to demonstrate power, and he will, I believe. I mean, we also heard from the BIS, they're saying that actually market valuations at this point are looking frothy. I know if we get a tax, bill passed, it also means that companies will have a lot more to give back to shareholders. Sure. But do stocks look expensive?
I think by my most historical measures against their own history, yes, they do. You can find measures where they look a lot more reasonable. Say real earnings yield, for example, is probably the measure on which the stock market looks best right now. If you compare the CAPE not to its long-run average, but to an average, say, of the last 25 years, which maybe more reflects the institutional framework we have now, they don't look egregiously overvalued. But yes, all of our long-term work suggests that one has to have very, very dampened expectations about the average annual compound return you can expect from this market over the next 5 to 10 years. Doesn't mean we get a sell-off over the next 12 to 24 months at all. And I think that when we're looking at the tax bill, there is, I think, a very interesting provision here, which is, of course, the expensing of investment. At the same time as I think at the moment, the most recent version maintains the deductibility of interest as well. If you think about it, that actually allows a negative tax rate on a lot of investment. So I think that could have quite significant sector ramifications for individual companies, and also produce, again, short-term and long-term. In the short term, I do think it could have quite a profound effect on certain parts of GDP over the next 4 to 6 quarters. The problem is it probably creates some fragility going into the next recession, because you're basically encouraging people to leverage up and make investments and buy stuff they wouldn't have bought unless you gave them the incentive to. That looks like a recipe for malinvestment, and a set of companies which will be more highly leveraged than they would have been going into the next downturn.